Well, the Federal Reserve meeting this week largely kept the interest rates unchanged as was widely expected. However, the data and the commentary revealed something more valuable, what's coming in the coming months and quarters. My name is Sunil Grover, and I'm the founding managing partner of True Blue Partners. At True Blue Partners, through our venture fund and affiliated funds, we provide company building services to founders of enterprise AI companies to build the next generation of leaders. The key highlights of this week's announcements and data are summarized in this deck here. The interest rates were expected to be unchanged. The headline was really around what goes on with the tariffs. Tariffs, as you know, are expected to drive one-time inflation. The word transitory, if you recall, is no longer used in the Fed's vocabulary. It's one time. They are not going to assume that this is going to be a one-time event until proven so. So what will happen as a result of that? I believe the Fed has made it very clear that they're going to wait and see until the whole impact of tariffs passes. How long does that mean? Well, we just heard on April 9th that the tariffs have been pushed off for another 90 days, except for the small 10% piece. So we'll see whether that small 10% piece has any effect in these 90 days and how these bilateral discussions like the one announced with UK start taking steam. China went down from 140% to 80% tariffs, but that's clearly not enough. That's just an opening bid. There's going to be a round of negotiations. What is happening as a result of that is that the ports are not receiving any more shipments from China. And we'll take a look a little bit more into the detail what that could potentially mean. What it does mean very clearly is that there is no anticipation of interest rates until about September. So give it 90 days and then give it 1 or 2 months, and then we'll see. Now that could change, but today nothing's expected to go lower on the interest rates until September. Tariffs are like taxes. We've discussed that before. It's going to have a one-time impact. And this quarter, the GDP went negative because the imports increased in anticipation of tariffs. That clearly is going to be a one-time thing. The core PCE numbers are coming in steady at 2.6%. That is good. What is not as good is they're not 2%. That's where Fed wants to see them. Remember, it was 1.5% in Feb 2021. So 1.5% is pretty close to a 2% annual where Fed would be very comfortable. And that's why at 1.5%, Fed was very happy to keep the interest rates at zero, below 1.5%, therefore putting some fuel to the fire, the economic fire engine, if you may. Month over month, the core PCE is at 0%, and the headline inflation CPI is at 0.1%. Those are both very positive numbers, but one data point a trend doesn't make. So will the tariffs cause a bump? Will that bump be one time or transitory? Headline inflation is trending downwards. Energy prices are declining. Crude is at $57 a barrel, but year over year, even the core PCI is at 2.8%, meaningfully higher than the Fed's target of 2%. The secondary mandate of the Fed, the job market, continues to be strong and is a regime priority. So I would expect that to stay healthy, which means that's a positive driver towards lowering interest rates. Valuations, meanwhile, have come down towards the end of last year, and then beginning of this year, there was a strong Trump bump, but now all that has been wiped off, and valuation, the way we look at it, is really revenue and EBITDA multiples for where it's relevant, whichever metric is relevant for those sections. AI and enterprise AI continues, to be the strong spot in the economy for investments and adoption.